So thanks to both of you guys for being here with us today. I guess we should start. Every entrepreneur needs to have an elevator pitch to explain to investors and partners, potential partners, what they do and why they're here. So what's your pitch today?
Yeah, so Point is the first financial technology platform for home equity that allows homeowners to unlock equity that's locked up in their homes. It's a brand new consumer finance product for consumers. And on the other side, it's a brand new asset class for investors to get access to.
Okay, and Ryan?
Yeah, we are building the world's first digital stock market for alternative assets. We're looking to transform the world of alternative investing by providing more transparency, access, efficiency, and ultimately liquidity, and completely reshape who can participate in our global economy and how they can participate.
Okay, but I just want to underpin right here that you're both focused on real estate. Eddie is more on the residential side, and Ryan's more on the commercial side. Eddie, you are a serial entrepreneur, but you founded this real estate company or going into this market after doing a lot of things in the payment space and fintech space previously. What got you here? Why are you working on this particular problem?
Yes, I've started a few venture-backed companies now, and the unifying theme across them, payments, online to offline affiliate networks, was finding an inefficiency in a market and creating a business out of it. So with Point, I followed that playbook. A little over 2 years ago, I was in between jobs, in between starting companies. I didn't have income, so I was in the penalty box, and so just when I wanted a refinance the most, the banks rejected me. So that's why I stepped back and asked, well, why is debt financing my only option? I own all this equity in my home. I can go and sell equity in a startup. I can buy equity in commercial real estate. Why can't I sell shares in my home just like I can sell shares in Apple and Google? And so that's where this idea for building a shared equity platform came from.
Okay. And Ryan, how about you? You have some experience in the real estate world previously. How did you get to where you are now?
Yeah, so I guess the unifying theme for me is I've always been pretty passionate about tech and antiquated industries. I started a sports technology company about 16 years ago when Amazon and e-commerce were still buzzwords. And most recently, spent some time building a single-family real estate tech platform during the subprime credit crisis timeframe, so 08, 09. And I decided that after spending some time at Blackstone, the world's largest owner of real estate, I wanted to apply technology to commercial real estate, because commercial real estate is one of the most important asset classes to build multi-generational wealth, but it's also one of the most opaque. And technology, as folks are aware, is one of the key catalysts to evolving opaque relationship-driven industries. And so that was the idea, and since then we've had some great momentum.
So I want to bring it back a little bit, just because I'm interested in what you were doing after 08, 09.
Yeah.
I think it's kind of an interesting story, just given your background. What were you doing in real estate at that point?
Sure. So I stumbled upon the opportunity, as it sometimes happens. Was actually in Atlanta with a college roommate, and I noticed there were all these foreclosed homes up and down the street. And I asked him, what are these homes being auctioned for? He didn't quite know, but he knew they were pretty big discounts. And so that was the first sort of aha moment for me, is that these homes that should all have a profile, they should all have information, they should be mappable, were not. And the second sort of question I asked him was, where are they in the foreclosure process? He didn't know that either. And so I decided that I could answer both of those questions using technology and data, generally all publicly available data, to track homes and to price the homes, and to start buying, investing in the homes, but also propping up a lot of these communities. And so I did that, and we ended up buying dozens of homes, hundreds of units, and that ultimately is what led me to join Blackstone and their real estate group, in large part because there was overlap in their excitement and engagement about the single-family real estate business and what I had also created.
Okay. When you talk about the single-family business and propping up these communities, helping people stay within their community and that type of thing, you went from that to essentially making commercial real estate easier for institutional investors to get access to.
Right.
So why that pivot?
Yeah.
You have sort of this like social mission-driven, thing that you're doing, and now you're just like helping rich people get richer.
Well, I disagree with that, and it's an important point, though, and I do think we should double-click on it a bit, because it is a misconception. But I think it's important to understand in fintech and real estate tech, credibility, brand equity, trust is everything. And we're taking an approach where we want to build what we know will be one of the most transformational marketplaces at the top of the investing ecosystem. We want to create credibility and social proof. We want Cadre to be established as that domain and that hub for high quality access to opportunities. And we know that if we do that, we'll build an enduring business where we will have the optionality to open up our marketplace to a much wider subset of our global economy versus taking an approach where we're trying to go out to millions and millions of individuals where there's oftentimes adverse selection, litigation risk, and frankly, a lack of quality control. And so I would actually say that we're not looking to make the rich richer. We're looking to increase access and reshape who can participate and how they can participate, but we're taking a little bit more of a targeted approach out the gate. This will ultimately transcend sort of institutional investors and be accessible for anyone. And I think that's, again, the important nuance in fintech versus sort of some of the consumer sort of spaces and domains, is that credibility.
Now, both of you are talking about this sort of in the same realm as building a new type of market, liquid market, like a stock market. Given what happened a decade ago with the housing crisis and the financial crisis, what is the investor appetite for, creating more liquid access to these types of assets?
One of the interesting things about residential real estate is residential real estate, like venture capital, is an inefficient asset class. Right? There's no way to short the unicorns. There was no way to short the speculators during the downturn. And without equity as a financing instrument, there's only debt, right? And so it means that by creating a liquid market, by creating more ways to finance, more ways to be liquid, you can actually smooth out the boom and bust cycles that have defined residential. And if you think about the millions of homeowners who were actually underwater by 07, 08, if there had been a way for them to share some of that equity risk, some of that equity downside, right, you would have created diversification benefits for not just homeowners, but also investors.
Right. When we talk about investing in these illiquid assets, whether it is real estate or whether it's venture-backed companies, for instance, I feel like there's a certain amount of elitism in that consumer or retail investors wouldn't even know what they're looking at, right? So we have to keep them out of the market so that they don't get duped or they don't get taken advantage of or they don't lose all of their money. What would you say to that type of a critique for the marketplaces that you're building?
So in our case, I think what's really interesting about Point, right, is take a Lending Club or Prosper. Those borrowers on the platform are generally not investors on the platform. They're only on one side of it. Our homeowners, by virtue of having hundreds of thousands of dollars of wealth trapped in their homes, right, they actually have a wealth diversification problem, right? It's like having a stock portfolio with a single stock in it. So as we scale, what better way for us to build network effects and for our homeowners to diversify than taking money out of their home, selling us equity, and putting it right back into the platform and just diversifying their equity risk.
Okay.
Yeah, and I think from our perspective, our mission is twofold. It's providing superior access, but it's also providing superior insight to real estate investing. And I think that two-dimensional element is critical because I agree that there's sort of an important responsibility when you're dealing with people's financial futures, that you don't just bring them into the home, so to speak, to use one of your analogies, but you give them sort of a layout, a blueprint of the home so they can navigate that effectively. And at Cadre, we're leveraging data to actually give people tools, insights, build a recommendation engine for their lives so that they can be empowered like the institutions. Because that's how institutions have been able to charge the levels of fees. They've been able to say, you know, our knowledge base, our experience is worth whatever. In our space, the 2 and 20 in the promote land. And what we're saying is, well, actually, we can democratize insight, and we can empower a wider subset of our economy. So I think that access is critical, but it's also about creating sort of a data engine beneath that that can truly power people's futures.
Right. Eddie, I'm wondering if you could just put a little bit of a finer point on this. Why is selling equity a better model for unlocking value in your home rather than taking on debt? I mean, it sounds obvious, but let's just put it out there.
So really what we're trying to do is, equity is a complement to debt, right? In the corporate world, sometimes it makes sense to issue bonds, sometimes it makes sense to issue stocks, and depends on the situation. So the same idea here. We have consumers who are using this for wealth diversification. They're taking money out of their home to invest in their small business, to invest in an investment property, or to reinvest back in the home. We have consumers who are using this for education, right, for college, for their kids. And then we have other consumers who are using this to bridge either to their next home or use this as a credit bridge to a prime mortgage. So it really makes sense. And in our case, homeowners who have accumulated equity and who are optimizing for cash flow, right, makes a lot of sense. But debt always will exist, right? What we're trying to do is the $18 trillion that's locked up in U.S. residential real estate, right? $2 trillion of that can be accessible and unlocked by companies like us. And that actually is one of the best ways, if you think about it from a macro perspective, one of the best ways to unlock wealth and put it right back into the economy.
I guess the biggest question that I have is, since this is such a new model, how you make sure that all of the interests of all the stakeholders are aligned. Obviously, you know, the homeowner will want to unlock some value in their home. Investors want to diversify their assets. But you have a 10-year term, and so I can imagine a situation where a homeowner, you know, sells 10% or whatever in their home. 10 years pass, they don't want to move, but they don't have the cash to pay back the investor. So what happens in that case?
So what's great about our platform and our product, right? We're a product innovation company, right? Fintech is a lot of fintech is process innovation, right? Automating, bringing things online. Kind of improving data ingestion. We do all of that, but we're fundamentally a product innovation company. And what's really radical about equity investments is it creates a natural alignment, right? So when the homeowner does well, when their property goes up in value, we earn more profit, but the homeowner also does better. And likewise, when their home is stagnating or doesn't do as well, we don't do as well either, and our investors don't do as well. So it creates this natural alignment where we can build resources and tools and products from that vantage point of co-ownership, right? Who better to advise you on things about your home, right? Home insurance policy, a better refinance, selling your home at a higher price than a person that is aligned with you from an ownership perspective.
I don't think you answered what happens in that hypothetical, though.
So the great thing is our homeowners, right, they've accumulated equity. Many of them have lived in their homes on average for over 10 years, right? So many of them line of sight to selling, or they're using us for one of these short-term bridge cases. In the absolute worst case, where they get to the end of the term, right, we'll have a few options for them. They can either refinance this out with another equity investment, or they can use traditional debt products to exit.
Okay. So it's time for me to put Ryan on the spot. Let's talk about Jared Kushner. 2 weeks ago, Cadre was sort of at the center of this story that ties together Jared Kushner, Goldman Sachs, George Soros, Peter Thiel. Can you explain how all of those people and institutions came together?
So at Cadre, we have a pretty powerful mission, and there's nothing, even if it was dynamics in DC, that would change or disrupt, to use the name and theme of this conference, achieving our mission. And to that end, we've had a lot of great folks back us across the board, across political spectrums. Jared was a great partner, friend in the early days of Cadre. And we generally don't like getting into dynamics around the company that we don't think are pertinent to achieving our mission. And so I think that sort of would address that point.
I mean, I understand that, and you know, the 3 or 4 years ago when this company was founded, there was no way for you to know that he would be Trump's son-in-law. But I just did name 3 or 4 more controversial figures. How, as your investors and partners, how does being associated with them reflect back on you and reflect back on the company?
It does not reflect on our ability to execute or realize our mission. Again, we are in a space that is relationship-driven, traditional. We have an incredible team. We have an incredible set of investment professionals, engineers, designers working to achieve our mission, and we're not a political organization, right? We don't have any political ties or affiliations. We focus on, first and foremost, transforming the world of real estate and alternative investing. And again, nothing's going to stop us from doing that,
right.
Despite what you guys might read about.
Yeah, and by the way, it all makes sense, right? Like, I would want, you know, real estate magnates on my board too if I were starting a company of this type.
Let me just tell you, look, and we have a great team. We've prospered in the face of adversity. We've worked through challenges unforeseen. And I think it does a disservice to the team, the mission, and the other investors when folks focus on you know, not the technology and not the realization of the mission, but a lot of the noise and inaccuracies. And so you know, I was excited to come to speak to what we're doing and how we're doing it, not to speak to any of the noise that I think just distracts us from an already difficult mission that I know we'll achieve.
Okay. I think the bigger question that I'm asking here is how important are investors, their beliefs, their actions when you choose partners to sort of go to business with and go to bat for you. Eddie, I looked at your Crunchbase and I didn't find any Peter Thiels. So I'm curious what your thoughts were. You know, was that by design? And how do you choose your partners?
Actually, we don't know Peter, so if you can make an introduction, that'd be great. For us, it was really, we had prior relationships with Andreessen Horowitz, our lead investor, and they're a great investor, and they have that alignment in place, right? Which is in some ways similar to the alignment that we like to achieve, right? They have resources and advice to kind of maximize the value of their portfolio companies, right? So it's win-win. In the same way, we're building products and providing resources, right, to align ourselves with our customers.
Okay, so probably our last question. We'll see. Wondering how you think about the real estate market today, and if we were to, spin this up out of whole cloth, like brand new, given all the technology that we have, given all the data that we have. How would the way that homes or offices or whatever be bought and sold differently if we were to start from scratch?
I think for us, it's really just, the irony is this is the U.S. residential real estate is the biggest asset class in the world. It's one of the very few where the only type of financing is debt, right? So that's just a strange way to have created an ecosystem. For us, I think one of the interesting macro things over the last 10 years, right, following the bust, was there's been this we've gone a little too far on credit reform, right, and to the point where nearly 50% of homeowners today can't even access a prime Fannie or Freddie mortgage. So it's created this massive white space between GSEs, Fannie and Freddie, and everything else. And there's a really interesting opportunity for us to come in and innovate in the home equity space.
Okay. Ryan, how would you do things differently? For the market, how would you do things differently for the market?
I think the beauty of our business and our marketplace is that we do have a pretty flexible mandate. We are creating a platform for people to more efficiently access and buy but we're also creating a two-sided marketplace, right? Where for the first time ever, there'll be parity between buying and selling because of technology-enabled transparency. So if and when there's a downturn in the market, we'll be resilient because we'll be able to provide an opportunity to sell and liquidity. And so we focus on the market conditions a lot more on the buy. But I think the beauty of real estate is it's a massive, massive industry, right? And because of that, there are always bound to be inefficiencies. And we are an operator-driven model. We're technology-enabled, and that gives us a little bit more wiggle room because just on a risk-adjusted basis, we're superior to any alternatives, and we can be resilient through market cycles. So we focus a lot more on the core product versus sort of external dynamics.
Okay. Excellent. Well, thanks again for your time, and thanks everybody for being in the room.
Thank you.